In August 1971, America was losing gold. Foreign governments, France most aggressively, were converting their dollar reserves to gold at the Federal Reserve, draining America's gold supply faster than it could be replenished. The Bretton Woods system required America to exchange dollars for gold at $35 per ounce on demand. By 1971, America did not have enough gold to honor that commitment at scale. Nixon faced a choice: deflate the American economy to defend the gold standard, or end the gold standard. He chose to end it. What nobody anticipated, the dollar became more dominant afterward. The exorbitant privilege got more exorbitant. This episode explains how. On the evening of Friday, August 13, 1971, Nixon summoned 10 of his most senior economic advisors to Camp David. Treasury Secretary John Connally dominated the meeting. Federal Reserve Chairman Arthur Burns opposed ending the gold standard. Nixon had made up his mind before the meeting began. The group worked through the weekend, drafting an announcement, preparing a wage price freeze to manage inflationary expectations, planning the diplomatic fallout with allies. Not one of the 43 other nations whose monetary systems depended on the dollar-gold convertibility commitment was consulted. America's allies learned about the decision on Sunday evening from a television broadcast. The Bretton Woods system, designed in July 1944 at the Mount Washington Hotel in Bretton Woods, New Hampshire, was the most ambitious international monetary cooperation in history. 44 allied nations gathered to design a post-war monetary order that would prevent the competitive devaluations and trade wars of the 1930s that had contributed to WWII's conditions. The system's architect, John Maynard Keynes for Britain and Harry Dexter White for America. The result, the dollar as the world's reserve currency, convertible to gold at a fixed $35 per ounce. Every other currency pegged to the dollar. The International Monetary Fund and World Bank created as its institutional infrastructure. It was the most elegant monetary architecture ever designed. The Bretton Woods system worked extraordinarily well for approximately 20 years. The post-war economic expansion of the 1950s and 1960s was the fastest sustained growth in human history across the Western world. The system provided exchange rate stability that allowed trade to expand, investment to flow, and businesses to plan across borders without currency risk. Its flaw was structural and specific. It required America to run balance of payments deficits to supply the world with the dollars it needed for trade. But those deficits accumulated as foreign dollar holdings that could be converted to gold. As America's economic dominance relative to recovering Europe and Japan declined, the gap between dollars outstanding and gold available widened. The system was consuming itself. On Sunday evening, August 15, 1971, Nixon interrupted Bonanza, the most-watched television program in America, to address the nation on the economy. His announcement, a 90-day wage and price freeze to combat inflation, a 10% surcharge on imports, and buried in the middle of the address, the suspension of dollar-to-gold convertibility. Nixon framed the gold suspension as a temporary measure to defend the dollar against international speculators. He did not describe it as the end of the Bretton Woods system. He did not consult the system's other participants beforehand. He presented a structural redesign of the global economy as a defensive emergency measure. The framing was politically effective. The consequence was permanent. The international reaction was immediate and furious. West Germany's finance minister Karl Schiller called it a declaration of monetary war. The French described it as exorbitant irresponsibility, a play on Valéry Giscard d'Estaing's earlier phrase, exorbitant privilege, describing the dollar's Bretton Woods advantages. The Japanese government convened an emergency cabinet session. European currency exchanges closed temporarily to prevent chaotic trading. The British Chancellor of the Exchequer was informed of the decision hours before the broadcast. Not days, not weeks. The specific diplomatic insult was calculated. Connally had told Nixon that the Allies had no choice but to accept whatever America decided, because they needed dollar-denominated trade more than America needed their cooperation. He was correct. The conventional expectation, shared by most economists in 1971, was that ending gold convertibility would weaken the dollar. If the dollar was no longer backed by gold, what gave it value? The answer that emerged over the following decade was specific and structural. The dollar's value came not from its gold backing but from the network effects of its universal use in global trade. Oil was priced in dollars. Commodity contracts were denominated in dollars. International debt was issued in dollars. Banking reserves were held in dollars. The infrastructure of global trade had been built around dollar denomination during the Bretton Woods era, and that infrastructure did not disappear when the gold backing did. The dollar's network was its backing. The petrodollar arrangement, sealed in the 1974 agreement between Treasury Secretary Kissinger and Saudi Arabia, was the specific institutional mechanism that locked the post-gold dollar into the global economy permanently. Saudi Arabia agreed to price all oil sales exclusively in dollars and to invest surplus oil revenues in U.S. Treasury bonds. In exchange, American security guarantees and military equipment. The arrangement meant that any country needing to buy oil, which meant every industrial economy, needed to hold dollars. The demand for dollars to purchase oil created permanent structural demand for the currency, regardless of gold backing. Nixon ended the gold standard in 1971. Kissinger replaced it with oil in 1974. The dollar had a new anchor. It was more powerful than gold. The phrase exorbitant privilege, used by French Finance Minister Valéry Giscard d'Estaing in the 1960s to describe America's monetary advantage, describes something specific and measurable. Because the dollar is the global reserve currency, America can borrow in its own currency at lower interest rates than any other government. The world's appetite for dollar-denominated assets, treasury bonds, in particular, means America's borrowing costs are suppressed by global demand. America can run trade deficits without the currency crises that would punish any other country running equivalent deficits. It can impose financial sanctions by cutting adversaries off from dollar payment systems. And it can print money during crises 2008, Colorado vid 2022, in quantities that would collapse any other currency. The privilege is real, and it compounds. The privilege has a specific cost to the rest of the world that is the source of every de-dollarization impulse in 2026. Because global trade requires dollars, countries must earn dollars through exports before they can participate in international markets, or borrow them at rates America's monetary policy determines. When the Federal Reserve raises interest rates to fight American inflation, every developing country with dollar-denominated debt faces higher borrowing costs, capital outflows, and potential currency crises, even if their own economies are performing well. American monetary policy is simultaneously domestic economic management and involuntary global monetary policy imposed on every country whose debt, trade, or reserves are dollar-denominated. The privilege is American. The cost is distributed globally. The de-dollarization movement of 2025 and 2026, BRICS payment systems, Saudi yuan oil sales, Chinese digital currency ambitions, Russian ruble-denominated energy contracts, is real in its political intent and limited in its practical progress. The specific structural obstacle, replacing the dollar as global reserve currency, requires not just an alternative currency, but an alternative system of the institutions, markets, and network effects that make the dollar indispensable. China's renminbi is not freely convertible. Foreigners cannot hold unlimited renminbi assets or move them freely across borders. Without free convertibility, a currency cannot function as a global reserve. Beijing cannot make the renminbi freely convertible without accepting the capital market liberalization that would expose Chinese financial institutions to external discipline. That discipline is incompatible with the Communist Party's control of the financial system. The most honest assessment of de-dollarization in 2026 is that it is real at the margins and structural at the core. The dollar's share of global foreign exchange reserves has declined from approximately 70% in 2000 to approximately 58% in 2024, a meaningful reduction over 24 years. The euro, Chinese renminbi, and other currencies have captured some of the decline. But 58% share in a vastly larger global economy represents more dollar-denominated assets in absolute terms than 70% did in 2000. The dollar has been losing share and gaining scale simultaneously. De-dollarization at the margin is real. Dollar dominance at the core is intact. The two facts coexist because the global economy has grown faster than any alternative has captured share. The dollar system's human consequences are most visible in two specific phenomena: the extraordinary American standard of living that the exorbitant privilege partially sustains, and the specific vulnerability it creates for developing countries whose debt and trade are denominated in a currency their central banks cannot print. American consumers benefit from the dollar's reserve status through lower mortgage rates, lower government borrowing costs that reduce tax burdens, and cheaper imports priced in dollars that American purchasing power, amplified by reserve currency status, can buy at suppressed prices. The specific calculation, reserve currency status, is worth an estimated $500 billion per year to the American economy in reduced borrowing costs and terms of trade advantages. The privilege is not abstract. It is in every American's mortgage rate. The dollar system's most consequential human cost is visible in the specific vulnerability of developing country populations to dollar monetary conditions they cannot influence. When the Federal Reserve tightened aggressively in 2022 to fight American inflation, capital flowed from developing markets to dollar assets, causing currency crises in Sri Lanka, Pakistan, Egypt, and Argentina simultaneously. These crises produced food price spikes, import shortages, and economic contractions that affected hundreds of millions of people who had no relationship to American inflation, no voice in Federal Reserve decisions, and no protection from the consequences. The dollar system distributes its benefits to Americans and its adjustment costs to developing countries. That distributional reality is what makes de-dollarization a political project, even when it is structurally difficult. The specific legacy of Nixon's August 15, 1971 decision is the global monetary system that still governs the world economy in 2026, 55 years after the gold standard ended. The dollar has no gold backing. It has not had gold backing since that Sunday evening broadcast. What it has instead is the accumulated infrastructure of 55 years of dollar-denominated global trade. The oil contracts, the bond markets, the banking systems, the payment networks, the reserve holdings of central banks from Beijing to Lagos to Seoul. Dismantling that infrastructure requires simultaneously replacing everything that was built on it, and the coordination required to do so simultaneously across all participants has defeated every attempt mounted since 1971. Nixon ended the gold standard in one weekend. Replacing what he built has taken 55 years and is not complete. One Sunday evening, one television broadcast, one decision, made by 10 men over a weekend, without consulting 43 allied nations. That created the global monetary system, still governing the world economy in 2026. Nixon ended the gold standard because America was running out of gold. The dollar became more dominant because the world needed dollar-denominated trade more than it needed gold. Kissinger replaced gold with oil in 1974 and locked the arrangement in place. The exorbitant privilege compounded for 50 years. And in 2026, the BRICS nations, the digital currency advocates, and the de-dollarization theorists are discovering what Giscard d'Estaing discovered in 1965. The privilege is real, the cost is real, and ending it requires a coordination that the global financial system's own structure makes nearly impossible. The story continues next in our new series, Borders Drawn in Bad Faith, where we trace the 6 most consequential territorial decisions ever made by people who had never visited the territories they were dividing. Same analytical standard, same primary source commitment. Subscribe to the channel and turn on notifications, because the story doesn't end here, it evolves. The monetary system Nixon built is still running. The borders the next series examines are still producing the conflicts you watch in the news today. History in Progress continues.